Hi, my name is Ashma from JBA 1144J and this is my video presentation for subject FIN 327. Today, I'll be presenting about preferred shares and how do they behave during credit crunch. First, let's get to know what are preferred stocks. Preferred stocks are a hybrid of sorts. They have features of both stocks and bonds. Like common stocks, they represent ownership in a company. Like bonds, company must pay on a regular basis a set of amount of interest to preferred stock shareholders. Before we go deeper into the topic, let's check out a little bit of history. Preferred stocks have been around for a long time. The earliest issue was reportedly in year 1836 in Maryland, taking greater popularity in the 1990s. They are issued by companies in other countries including Canada, Germany, the UK, Brazil, and France. Next, let's check out the advantages investing in preferred stocks. Because preferred stock normally has higher and more regular dividends, it is less volatile than common stock and carries less risk. A preferred stock with a guaranteed dividend is often considered a fixed income investment similar to a bond. Another advantage to owning preferred stock is when a company stops paying a preferred dividend. The company must repay all the money it would have to pay to preferred shareholders before it can pay any dividends to common shareholders. On the flip side, if a company grows, the stock value can appreciate and so can dividend payouts. For investors, this fixed income characteristic makes preferred stock a good choice for a long-time retirement investments like an IRA. Another important characteristic of preferred shares is that sometimes, but not always, they give their owners the right to convert the preferred stocks into common stock at a pre-arranged price. This is attractive to preferred stockholders because they are entitled to the steady stream of dividends, plus they can enjoy appreciation in value if the company's stock rises. Next, let's find out the disadvantages investing in preferred stocks. Preferred stocks carry less risk than common stocks, but they have more risk than bonds and may not offer a better income from dividends than the interest on bonds. Because of the added risk, investors who own preferred stocks could see larger short-term losses than with bonds. Just as with common stocks, preferred stockholders are behind bondholders in line for a company's assets if it runs into a financial problem. If a company fails, money is repaid to bondholders first, and this adds default risk to the preferred stocks. Another downside is that preferred shareholders are usually excluded from voting on matters such as board of directors elections. One other point to make, there is no preferred stocks rating system similar to what's available with bond ratings. Not only that, but preferred shareholders will have to sell their shares back to the company in the future at a certain price. Finally, let's find out how preferred stocks behave during credit crunch. The stocks tend to stay relatively stable as long as the company's viability as an operating business is not questioned and the company do make their regular payments. situation above, the big move came amid rising doubt about what exposure financial institutions have to back loans that are likely to default if the coronavirus crisis continues well into the future. The sharp drop in bank preferred share prices suggests that investors believe that those loans represented a systemic threat to the financial system. Given the perturbation that bond market investors have had to endure in recent weeks, it's not surprising to see similar disruption showing up in the much less liquid preferred stock market. In conclusion, investing in preferred shares can either bring gains or losses. It all depends on the timing that we buy, the company we invest in, and the strategy that we use. During the credit crunch, if the right investment decisions are made, more profit can be gained when the stocks rebounds.